want to buy the stock at around $14 as opposed to closer to $51. And in this video, I'm going to show you exactly how to know when a stock is priced low and when it's priced high. But first, we need to quickly go over three definitions. So a share or a stock represents ownership of a company. So if you were to buy even a single share in a company, you would be part owner of that company. And as an owner of the company, you're entitled to share in the profits of the company. And those profits are paid out as dividends. So for example, if a company is paying out a dividend of $1 per share and you own 1,000 shares, you will receive $1,000 every year for as long as you own those shares and as long as the company continues to pay a dividend of $1 per share. And that money goes directly into your trading account. You can spend it as you wish or you can reinvest it. It's all up to you. The dividend yield is simply the dividend divided by the share price. So in this example, we'll take the same dividend of $1 per share, and let's assume the share price today is $20 a share. The dividend yield is going to be 5%. So the 5% represents here is the return on your investment while you're holding on to those shares. So let's say you have $5,000 to invest. So 5% of that is $250 in dividends each year for as long as you own the shares and as long as the company continues to pay a dividend. Another way to look at it is if you have the same $5,000 to invest, at $20 a share, you're going to be able to buy 250 shares. And again, the dividend is $1 per share, and you end up with $250 in dividends each year. So the 5% dividend yield is a very quick way to figure out, okay, what's the return on my investment while I'm holding on to these shares? Now, what happens if the share price starts to drop? So let's say we go from $20 a share to $15 a share. Or let's say we go even further down to $10 a share. Or if the share price drops to $5. So you can see that as the share price continues to go down, the dividend yield continues to go up. So again, let's go back to our example of $5,000 to invest. So if you were to buy these shares at $20 each, your return on investment would be 5%, which is the $250 in dividends that we looked at before. However, if you waited till the shares dropped to $5, the same $5,000 invested now would earn you 20%, which would mean $1,000 in dividends each year for as long as you own the shares in this company, and as long as the company continues to pay dividends. So you can see that as the share price drops, you're going to earn more in dividends. So it pays to buy low. So let's just go over this very quickly. So as we've seen, as the share price goes down, the dividend yield goes up. And the reverse is true. If the share price starts to go up again, the dividend yield is going to go down. So this is what I call the law of dividends. And this is very, very important because we need to know this in order to help us to figure out when a stock is priced low, when it's priced high. So I'm going to repeat this one last time here. As the share price starts to go down, the dividend yield will go up. As I said before, stock prices go up and down all the time. So in this example, what if I was to tell you that the average dividend yield for this stock over the last 5 or 10 years has been 4.5%. And the current dividend yield today is 8%. Now remember, as the stock price starts to go down, the dividend yield is going to go up. So the area below the dotted line, this is your buying area. That's where the stock price is going to be low. So anywhere below the dotted line, that's when you want to go out and perhaps think about buying stocks in this company, because that's where the stock is going to be undervalued. And if the current dividend yield today was 2.5%, then you know that the stock is overvalued and you may want to consider it for sale. So now let's take a look at a real life example with two companies. So we're going to look at IBM and Waste Management. These are two American corporations, and we're going to go figure out which one of these is undervalued and which one of them is overvalued. So what we're going to do is look at the current dividend yield and the average dividend yield for both. So let's start with IBM first. To get the dividend yield, we're going to go to the Yahoo Finance website. You can take a look at the URL at the very top left-hand corner. So here I'm going to enter the stock symbol for IBM. You can see that the dividend yield for IBM today is 3.91%. To get the average, we're going to click on Key Stats. Scroll down, and you can see that the 5-year average dividend yield for IBM is 2.08%. Let's go ahead and put both of those numbers into our table. So is IBM undervalued or overvalued today? Well, remember, when the current dividend yield is greater than the average dividend yield, the stock is undervalued. So IBM is undervalued. Now let's go take a look at Waste Management. Back to Yahoo Finance. I'm going to put in the stock ticker symbol for Waste Management, WM. You can see that the dividend yield today for Waste Management is 2.77%. We're going to click on Key Stats. The 5-year average dividend yield for Waste Management is 3.51%. So let's go ahead and put both of those values back into our table. Is Waste Management undervalued or overvalued? Well, we can see that the current dividend yield at 2.77% is less than its average dividend yield, so the stock is overvalued. So this is a really quick way to figure out if a company is priced low or if it's priced high. Now, you don't want to go out and buy IBM right away. As you know, the current dividend yield changes whenever the share price changes. So these numbers are valid as of today, but whenever you're ready to invest, you'd want to go and look at the current dividend yield again and compare it to its average dividend yield. Now, in addition to this, there's a couple of other things you want to check before you make any investment decisions, and I call that my 12 rules of simply investing. So the 12 rules are listed here on the screen. So what we looked at today was Rule 11B, was to look at the dividend yield. Now this is the most important rule on the screen. This is the one you want to check first. If a company does not meet this rule, so if a company is overvalued, then don't waste your time with any of the other rules. If a company is undervalued, then you want to go ahead and evaluate everything else and then make a decision whether or not you want to invest in this company.